Hey everyone, it's Mike Andes, and today I'm going to be talking about debt. I'm going to be talking and kind of clarifying some remarks that I made about a year ago when it came to Tigran Gertz and the debt that he has. Now, let me be very clear, I'm not trying to talk necessarily about Tigran, I'm trying to make a point here that we can all learn from. And so a year ago I made a video about buying new trucks and going into debt for equipment and how that was a bad thing. And I was actually wrong in the short term over the past year because of one thing, and that is that those assets that typically have been depreciating and in normal market times do depreciate have actually gone up in value. You can actually sell a used vehicle now that you bought new 2 years ago. You can literally sell it for more now after driving it for 2 years than you bought it for new 24 months ago. So I want to make a distinction. I'm not trying to talk about Tigran necessarily. I'm trying to make it a point here about you building wealth in your business and for your personal wealth and what it means as you try to grow your personal your personal net worth. So I want to be very clear that I don't believe debt is bad. And I think people watch those videos from a year ago and like, oh, you said debt is bad, like you're the Dave Ramsey kind of thing, right? Let me be very clear. I have over $3 million worth of debt. Okay, and someone that specifically has asked about this, they sent me an email and they sent a screenshot of one of Tigran's video. I think it was like $560,000. He said he's in debt right now because of equipment and trucks, etc. So let's just be very clear from a diagram standpoint. I have way more debt. All right, so let me explain to you what I feel there is good debt and there is bad debt. And let me be very clear, I'm not trying to pick on Tigran because he's made a very good decision by going in debt over the past couple years because all of that equipment, all the trucks that he has purchased have gone up in value. And the bottom line here is, in my opinion, the delineation between good debt and bad debt, if you're looking at from just an asset standpoint, not the benefits of what you could get from your business and cash flow, but just from an asset standpoint, debt on anything that goes up in value, good idea from a tax standpoint and from a net worth standpoint. Now, I'm not going to take into consideration the fact that when you get a piece of debt on a truck, you can make more money in your business. But again, that's assuming where we have massive assumptions there and you're going to take on more risk by leveraging and getting debt in order to get a new truck, new equipment, which would therefore then lead to more cash flow. But I'm looking strictly at the debt from a balance sheet standpoint, and I'm looking at what does it mean for taxes, because we're heading into the tax season and I want to explain why I feel debt on things that go up in value always a good deal. So Tigran made the right decision 2 years ago. I was wrong, he was right, because the trucks that he had purchased went up in value. So you win, because you basically didn't have to put any money in the deal. The value of that asset went up, and you have a surplus. You have equity inside of a truck, which is unheard of if you've lived the past several decades, but it's happened the past couple years because of the chip shortage and because of used price, just everything, the supply chain and all the rest of it. So I want to explain today, though, specifically when it comes to taxes, because a lot of the reason that Tigran talks about why he does this is for taxes, and I get it, he's doing the right thing. And that's why, in my opinion, he gives a lot of his equipment away, is because once he uses the first year, Section 179, he allows him to take that full depreciation the first year of buying that piece of equipment or that truck. That's why he's trying to give the equipment or the truck away after a couple years of being used, is because he can't take depreciation on his tax return. Because if you do it with Section 179 first year, why would you want to keep that piece of equipment around? Because you can't take any more tax deductions off of it. So give it away, take it as a loss, and then go buy another piece of equipment which you can take a loss on for your taxes and write it off on Section 179 all in 1 year. So let me explain to you from a tax standpoint, though, the difference between my debt and then equipment debt. So my debt, this $3 million in debt, is mostly, almost 100% exclusively, in real estate, on probably about $5 million worth of value of real estate, about $3 million in debt. Let me explain to you why this is good debt and why traditionally equipment and trucks, all that sort of debt, is typically bad debt. Let me be clear, I am not looking at what that debt here can do in terms of cash flow for your business. I'm a big fan of using debt, and I use debt to get my business off the ground. But once my business got to the point where it was producing a bunch of cash flow, I started thinking, instead of getting more debt, I'm going to take my cash flow and go get debt in real estate that will give me the same tax advantages as getting debt for my business, but it'll appreciate instead of depreciate. It'll go up in value instead of down in value. Let me explain. So up top here, this is what we're going to be looking from a tax standpoint with trucks and equipment. And then down here is going to be real estate. Or we'll just say, for the sake of this example, let's just say real estate, but you could talk about any sort of asset that goes up in value. But I'm going to use real estate for example. Up top here, we have taxes. You write all of it off in the first year. Section 179, great. You take a deduction because you got a $50,000 truck. And let's say you got a 5-year loan on that truck, it's $50,000. I'm going to get a $50,000 expense line item on this year's tax return. Great, it's going to save me probably, depending on how much money making, what state you're in, etc., probably going to save you like 15 grand on taxes this year. Fantastic. You're going to take all of that deduction in your first year. Your debt is going to be payments over the course of 5 years. So it's going to be a straight line all the way down your debt. We're not doing straight line depreciation because we took a section 179. Straight line depreciation would assume 5 years length of time, and I would take a fifth of my value. So I'd take $10,000 every single year as a deduction of my taxes. But if I take a section 179, I took all $50,000 of the deduction in year number 1. So, but the debt I'm going to pay off over the course of 5 years. The value of that truck, again, don't hold me to it on this, this curve. But the value of that truck typically over the course of 30 years is going to look something like this, okay? Like over 5 years, it goes down in value and then basically is scrap after 30 years, okay? Now let's compare that to what I consider really good debt. The more debt I can get down here, in my opinion, the better. Let me explain. Down at the bottom here, again, I'm not going to look at cash flow because, again, up here, this truck could be making me cash flow. Down here, my real estate could also be making me cash flow. I'm not looking at cash flow. I'm only looking at the asset value, all right? So first things first, debt. Over the course of 30 years, again, I'm looking at 30 years here, so let me just mark that here. So 10, 20, 30 years. I'm going to get a 30-year mortgage on, say, a duplex or a fourplex or something like that. Over the course of 30 years, my debt is going to be slowly paid off. Okay. Again, I'm not assuming any cash flow because I'm going to get cash flow above my debt service payments. That's great, etc. But and rents are going to go up. But I'm not taking that in consideration because I'm not taking in consideration the fact that on this truck I'm going to make also more cash from my business. I'm going to use that truck to do jobs. I'm not taking that into account. I'm only looking at asset value and balance sheet. So debt's going to come down over the 30 years. Depreciation is going to be over the course of 27 and a half years typically. So typically I'm going to do this. My depreciation is going to be over the course of, let's just say 30 years, but 27 and a half, 25 years, whatever you depreciate that real estate for, assuming that it is under 4 units and you're going to get a 30-year mortgage on it, you're going to depreciate it over the course of like 27 and a half, 30 years, whatever. So that is straight line appreciation. That means that if I buy a property for, let's just say $500,000, I'm going to take about, $20,000 as a deduction on my taxes every single year over the course of those 27 and a half, 30, whatever your depreciation schedule is, over the course of that time. Now, what's really cool though with real estate, again on average, is that it's going to go up in value. So instead of depreciating, instead of going down in value, it's actually going to go up in value. It's going to appreciate. So what's going to happen is over time, my debt is going down, my value of the property is going up, and what I'm left with is a bunch of equity. Now, this is the part that we've never talked about. And that is the fact that in real estate, you can actually take debt out against your equity that doesn't get taxed. The beautiful thing about building wealth in America is that equity doesn't get taxed to this date, right? The tax code could change. It actually might in terms of this sort of thing, in terms of trying to get capital gains or something from equity. But for now, I do not get charged any taxes. If this $500,000 property goes to $1 million in value, I did not have to get charged any more taxes on my $500,000 gain in value. all right? In fact, I took a deduction of depreciation every single year for my taxes. And so what's really cool though is I'm also getting depreciation, let's say $500,000, that full $500,000, I get that depreciation slice every year. I only had to pay 25% of that value, $125,000 in cash. So I put $125,000 in cash down on a property, okay? That gives me a $500,000 asset. I'm then able to depreciate a $500,000 asset over the course of 25 to 30 years. So I get like 4 times compounded the amount of depreciation on my taxes by putting only $125 down, getting all of this depreciation over the course of 25 to 30 years. But what's really cool is the value of the property is going to go up, and I'm going to get all of this equity. I can then take a home equity line of credit, or I can do a refinance, and all of that cash that comes out, I don't get taxed on. You do not get taxed on debt. And that is the beautiful thing about having debt. I love debt. But I love debt that comes with an asset that is going up in value, creates equity, and then I'm able to actually take money out of through a home equity line of credit or through a refinance at a very low interest rate, and that I don't have to pay taxes on. Because every single time I buy a new truck, every single time I buy another piece of equipment, I'm paying sales tax, I'm paying licensing fees, and then the value of that object, that asset, is going down. I can only take a 1-year depreciation schedule if I'm taking Section 179. If I take a straight line depreciation over the course of 5 years, that's fine, that's great, but like it's only 5 years. At the end of that 5 years, I don't really have a whole lot to show for it. So I understand that getting a truck, you can make a bunch of money on the back end, right? Because you're getting jobs, you're able to use that truck to actually make money. But once your business gets to the point where it's actually kicking out cash flow, I highly recommend, please, we're going to talk about this at conference, please take that cash, and instead of going and getting another truck and more equipment, or putting $10,000 on a $50,000 truck that's now you have a $40,000 loan on, take that cash that you get from your business and put it into an asset that you're able to get 4x the leverage on, 125 I put down on this property, getting a $500,000 asset. Put your money down on an asset that goes up in value, that you can depreciate on your taxes, that it appreciates and goes up in value over time, and that one day you're able to refinance or get a home equity line of credit without paying taxes on that money. This is what we as landscapers and lawn care professionals need to start thinking about, is our business as the cash flow source to one day invest in assets that go up in value, that depreciate very well for taxes, and that we can get money out, we can build wealth tax-free. I do not want to be in the constant cycle of spinning out more equipment and more trucks in order to just keep paying the tax man every single year and doing Section 179s every single year, just trying to keep on the treadmill of not paying Uncle Sam. You can create affordable housing, build your wealth, and do so in a way that allows you to grow your wealth without paying taxes. Okay, so I'm not against building debt on equipment for the first several years of business. I would give someone 3 to 5, even maybe 7 years to grow your business to the point where it's profitable, and then work on paying those loans down. Work on paying off the loans that you have that are 5, 6, 7, 10, 12% interest, and try to put that money towards something it's going to go up in value over time and have incredible tax advantages and allow you to build long-term wealth. People have always criticized me on my other channel when I talk about stocks and real estate that I'm just a landscaper. We are not just landscapers. If you're watching this channel, you want to grow your wealth. You want to grow your business. You're willing to learn and educate yourself and do the hard work on yourself to break what potentially past families, members, or you socioeconomically have been stuck in a certain area. You can get past that. You can break through that, and buying more equipment and going in and staying in the constant treadmill of debt is not the way to get there. Get to profitability in the next 3 to 5 years in your business. Stay concentrated. Focus on that. If you got to go get some loans on equipment and trucks, go for it. Do it. Great. But try to get your cash as you get past 5 years in business and you start to become very profitable, to get off the treadmill of buying more equipment, get off the treadmill of buying more depreciating assets, and get on the treadmill of plowing that money into assets to go up in value. Because this gap right here, this equity, whether it be halfway through here, right here, this is net worth. It's not getting taxed, and furthermore, it allows you to use this as piggy bank. You can get a home equity line of credit and use this as your break glass security blanket. All right, so when we want to invest into something like headquarters for Augusta, what am I going to do? I'm going to use the $2 million of equity that I have in real estate as if I need to break glass and get cash out, I can do so, and guess what? That cash won't get taxed. This is the type of thing that is extremely important for us to learn and grow our personal wealth. I'm very passionate about this, as I think it kind of comes across here. We're going to talk a little bit about this at the Conference Landscape Summit 2022, January 13th, 14th, and 15th. I'm actually opening up the weekend talking about this. I feel it's extremely important. I do not hate Tigran. We love each other. We got pictures together at JE. We love each other a bunch. I'm just using him as an example because several people have asked me, and I've seen comments from those videos way back when saying, like, are you against debt? Like, you're so stingy. And Tigran was right in the short term about the trucks because they went up in value. You want debt on anything that goes up in value. With the way that inflation is going right now, let's go. Getting debt is a good thing if you're trying to build wealth. But in the long term, you want to pay off debt of things that are going down in value, and you want to get as much assets that give you cash flow, appreciate, and you get great depreciation on your taxes. It's a great thing. I'm literally able to tell the IRS that I lose money on my properties every single year by taking a depreciation schedule, but at the same time it's going up in value, and I'm creating a gap of equity that I can actually take money out without paying taxes. Hope that was helpful. Comment below if this makes sense to you, if I can try to explain more. I try to make it somewhat simple. I know I'm using the example of trucks and equipment just to be relevant to the landscaping industry, but I hope it was helpful. That is not a bad thing if it's used correctly, and if you use it while you're growing your business, great. But get your business to the point in the next 5 years where it produces cash and you plow it into assets that go up in value.